Hello, and welcome to the Clouded Out audio blog. We're beginning a new series today analyzing the current status of the U.S. economy since the Great Recession of 2008. This series will cover a variety of topics, from those at the top federal level such as interest rates and gross domestic product, to those which are most important to us as consumers such as income growth and consumer debt. It is understood that all of these coexist and affect both parties, yet some more than others. The intent of this series is to explore a wide variety of topics, how they have been affected through previous recessions, what was seen during the Great Recession in 2008, and what one can extrapolate from the nearing future. This video serves as an introduction into this series and will give an idea of what all will be covered. But before we begin, tell us how you feel about the Great Recession. How were you affected by it, and what are some of your biggest concerns? Let us know in the comments below. That said, let's explore what the series is all about. The Great Recession of 2008, according to the National Bureau of Economic Research, was the worst recession in United States history since the Great Depression. The term Great Recession is a play on words associated with the term Great Depression. While there is no criteria for which to differentiate these terms, there is a near consensus among economists that during the 2008 and 2009, the United States did not reach the Depression status. This can be supported when looking at the statistics of the time period as follows. During the Great Depression of the 1930s, the United States experienced a decline in the gross domestic product, or GDP, of more than 10%, and unemployment reached a high of 25%. Conversely, during the Great Recession, the United States GDP declined a maximum of 2.8%, with an unemployment rate of near 10%. The Great Recession is unquestionably the worst economic downturn in the intervening years. The term Great Recession accurately conveyed its severity by invoking such a well-known economic calamity. The first signs of the Great Recession started in 2006 when sky-high housing prices began falling, a result of the subprime mortgage market bubble bursting. As the Great Recession proceeded, it resulted in the scarcity of valuable assets in the market economy, and the collapse of the entire U.S. financial sector, or banks, which quickly spread to overseas financial markets. Huffman outlines the full devastation experienced by the U.S. as a result of the recession as follows. The casualties in the United States included A. The entire investment banking industry, B. The biggest insurance company, C. The two enterprises chartered by the government to facilitate mortgage lending, D. The largest mortgage lender, and E. The largest saving and loan banks. The carnage was not limited to the financial sector, however, as companies that normally rely on credit suffered heavily. The American auto industry, for instance, which pleaded for a federal bailout, found itself at the edge of an abyss. Still more ominously, banks, trusting no one to pay them back, simply stopped making the loans that businesses needed to regulate their cash flows and without which they could not do business. Share prices plunged throughout the world. The Dow Jones Industrial Average in the United States lost 33.8% of its value in 2008, and by the end of the year, a deep recession had enveloped most of the globe. To quickly combat and hopefully lessen the impact felt by the recession, the government intervened by instituting numerous fiscal and monetary policies. According to Amadeo, by August 2007, the Federal Reserve responded to the subprime mortgage crisis by adding $24 billion in liquidity to the banking system. By September 2008, Congress approved a $700 billion bank bailout, now known as TARP. By March 2009, Obama proposed the $787 billion economic stimulus package. Additionally, the Federal Reserve lowered interest rates from 5.25% to 0.25% and kept them near zero for years to come. According to the United States National Bureau of Economic Research, the recession officially ended in 2009. Since then, how have things gone in the U.S.? To analyze this, a number of key topics must be explored. To keep things brief and to focus on the topics which seem to matter most in terms of economists and economic growth, the following will be covered. At the federal level, we'll explore interest rates, quantitative easing, which also includes federally held mortgage-backed securities and federally held U.S. Treasury securities. We'll look at federal debt, which covers government spending, bailouts, and stimulus, the gross domestic product, and the unemployment and job growth. At the consumer level, we'll look at income growth, the inflation, and consumer price index. We'll look at consumer spending and consumer debt and the number of delinquencies. Look at the stock market, wealth effect and savings, as well as gold and silver. For each, the topic will be defined as well as indicating its importance in the economy. Additionally, an analysis will be performed looking at how that topic has trended throughout history with respect to previous recessions, and how it's currently trending with its projection into the future. A dissection of each topic will indicate which school of economy has influenced it and whether or not its effects are truly beneficial or are simply an indication of false hope. Many of these topics are coupled together, meaning the effects of one can have consequential effects on the other. Due to this fact, analyzing a topic solely by itself is a little bit tricky. Because of this obstacle, the intention is to analyze top-level government or federal topics and policies first, and subsequently relate back to them when discussing lower-level consumer topics. For example, federally controlled interest rates may correlate to consumer debt. Therefore, when analyzing consumer debt, conclusions and findings about the interest rates will be referred to. It is hoped that you will enjoy this series. In addition to possibly learning something new,
you can read this article along with many others, as well as
predictions
sources on cloudofdoubt.com.
Which topics most concern you?
To be notified of our blog
Let
posts,
us know in the comments below.
you can subscribe on cloudofdoubt.com.
Thank you for spending a piece of your day with Cloud of Doubt.
You can follow us on a variety of other social media platforms, such as Facebook, Twitter, Google+, Pinterest, and Minds.com. The links are down below in the video description. If you have any comments about this video, comment below. We'd love to hear what you have to say. If you like this video, give it a thumbs up and share it with your friends. If you would like to be notified when new videos are posted, please subscribe and enable notifications. All of this helps YouTube know that this is quality content that you like and enjoy, and it will recommend videos like these to viewers like you. Stay tuned for the next video, and we look forward to seeing and hearing from you in the future. Thank you for watching, and as always, stay informed.